Welcome to Power Charting. I'm Bruce Fraser, your host, and our topic today is stocks yield and bonds don't. So is there some thing that we can derive from the relationship of stock yields to bond yields? Currently, over $15 trillion of bonds have negative yields. In the United States, bonds have positive yields. And this is the relationship that we're going to look at. It's a brave new world. And we want to see whether we can compare these yield characteristics and see if we can derive some idea for the opportunity for the stock market and potentially for the bond market too. So let's have a look at that. But first, we had promised, well, a couple of announcements. First, the TSAA-SF is having their annual conference, and these speakers are fabulous. This is going to be a day-long conference. It's a total bargain. It's going to be a lot of fun. You get to hang out with like-minded people, and these wonderful speakers are, which are many of them are known to you. I think that Craig Johnson is one of the best relative strength analysts on stocks, sectors, industry groups there is in the business. Dave Landry, hugely well known and dynamic speaker. John Lewis, Dorsey Wright talk about point and figure. Robin Mesh and our own Greg Schnell here at StockCharts.com. Very exciting. It's going to be a great day, and they've given power charting viewers a special rate. So I'm really excited about that. So the special non-member rate here is $125, which is $50 off the regular non-member rate, and it includes lunch. So it's really going to be a great time. We're going to have a lot of fun hanging out and listening to these speakers. Roman Bogomazov is going to have a fall course cycle. And so this is going to be led off with the Wyckoff market discussions, which Roman and I do together. There's going to be a free session on August 28th, and you can go to wyckoffanalytics.com and register for that. And we will be doing a special free session. We do these sessions every week. Also, Best of Wyckoff Online Conference is a conference that was started by Hank Pruden, and it's a tradition now, and we have a great list of speakers, and heaven forbid I'm the keynote. So I just learned that. So now the pressure's really on me. I'm going to talk about point and figure, and do some work on different techniques in point and figure analysis in my presentation. You do not need to be there live for the conference because it will be recorded. So consider attending that. And also, Roman is starting his trading course fall cycle, and he has a special rate. So check that out also. So hope to see you at Best of Wyckoff and definitely at the TSAA. We had promised to talk about some market interest situations at the beginning of each episode. You've seen this chart before, so I'm not going to spend any time on it. Beautiful campaign, accumulation count. We had accumulation, 2 reaccumulation counts that nested in the same area. And so this produced a distribution. And here was a distribution on an intraday basis. We've already studied this. Keep this in mind, 28.29, 28.56. This was the target that we had for the S&P, and we're going to go back and revisit that and see what has happened since. So let's get to it. This is a 60-minute intraday vertical chart of the S&P. This area up here we had just looked at, and it produced a distribution count, and we said it had gone down to this 28.40 level right here and 28.56, which is right here. So it did a wonderful job of getting us right down into the nesting area of the lows. Well, we had talked about that previously. We won't spend much time on it, but what we did say was that with this climactic surge into a point and figure count, that we were liable to get some kind of a pause, volatile pause, that would spend time building count for either accumulation and a rise, or distribution, a redistribution and a decline. So notice here that we have a very good rally up to the resistance area, and attempts to go down, which are producing higher lows and are very shallow. Volume is diminishing. This is encouraging for the bull case. And so we see that there is already a count here, an important test of this low. We could count this, but we have to understand that the count may not be complete. And we still could have a surprise decline, and the count could become larger. So it could go down further, or it could go down, have a very rally of very poor quality, and then resume the downtrend. So we must keep that in mind. And really, that's the subject of today's whole session, is on what's likely to happen with stocks here. So we go to the bigger picture to help inform this near-term situation that we have in the S&P. But the S&P is acting, really true to form right now. And so here, and the Dow, by the way, is very similar to this. I have charts of this, but I'm not going to show them because I don't think we really have the time. Is that in the case of the S&P, we have 3-box reversal, 60-minute data, 3-box reversal, 5-point scaling. We count across here, this is a total of 15 columns times 3-box reversal times 5-point scaling, gives us a count of 315 S&P points. And this is on the intraday. The count may not be complete, as we just said, and it's still possible that volatility could emerge down to the lows and maybe even produce complete redistribution. So, but right now we like the way this is hanging out at the top of the range and doesn't seem to want to go back down again. These 315 points counted from the low here, 28.25, takes us up to, 28.30 counts up to 31.45, which is above these highs right here. And so there is new highs are potential in the intraday on the point figure, and this could be the beginning or the kickoff to a more important rally. So we're just going to have to wait and see, and recognize that we're still in this range bound condition in this trading range. Now, switching gears into the area that we want to cover today. Hang on. I want to get my writing tool in place here so that we can highlight these. Now, this is one view of two important yield series. One is the S&P 500 dividend yield, and this is the US Treasury 20-year yield. And what I'd like to point out here is that these yields are within 1 basis point of each other. And so the yield on treasuries is actually a basis point lower than the yield is on the S&P 500. Well, is the stock market really a bond surrogate? Is the stock market the place to go to get yield now, instead of going to the bond market? Well, let's consider this, because if this is truly the case, we should see funds start to migrate away from bonds and towards the stock market. There's all this concern about the stock market and the volatility, and it could go lower, and there's worry that now here is the drop in yield since October of last year. Precipitous decline in bond yields since last year. Well, the concern is that this decline in yields is actually indicative of a coming recession. And that very well could be the case. But right now, we do have evidence of the economy continuing to move along at a slower pace, but it's still expanding. So now here, notice this area up here for the S&P 500 back in early 2016 was a huge spike in yields. Well, that was the result of falling stock prices. So falling stock prices created a very high yield. And at the same time, you had bonds yields dropping, which meant that bonds were in a bull run. Stock prices were rising. And so with that the case, first, stocks become very cheap because yields are high, prices are low, and bonds become very expensive here because yields are low, prices are high. Very similar to what we have right now. And then you had bonds start to rally, I'm sure very much engineered by the Fed, because the rising or the falling yields was engineered by the Fed to help create a bull market in stocks, a bull run, which is exactly what we got. And so here we can see that we have a big drop in yields, and we have had very high yields in the S&P 500, and the S&P 500 started to rally as a result of falling bond yields. So that's a typical relationship. That's the way things typically happen. Okay, so with that in mind, let's see if we can put together this data in such a way that it has more, makes a clearer picture for us. Okay, so here we're going to move on to our next chart, and this chart is the same data with the S&P 500 index drawn underneath. And what we've done is we've combined the relationship here of the bond yields to the S&P 500 yield, and we're asking the question, the key point, which is, are stocks the better yielding instrument to buy now than bonds? And we see here, this is back in 2003, which was the beginning of this important, this here was a beautiful accumulation for an important bull market. And we can see that bond yields were dropping, which falling bond yields is supportive of stock prices, and eventually as bond yields fell because the economy was in recession and stocks were declining in a bear market, well, eventually bond yields got low enough that it produced a base, an accumulation in stocks for that bull run. Well, then we can see that in the 06, 07, 08 top and bear market, here we can see that bonds started to fall and continued to fall. Well, this time a new relationship formed because bond yields got so low that they were equal to the yield on the S&P 500. And so that made stocks very, very attractive and produced in a very important accumulation area, which is this green box down here. And the blue arrow that we see represents the point at which approximately where we had parity between bond yields, US Treasuries, and stock yield. So stocks became very cheap and a good value, and this produced a new bull market which started in 2009. Well, subsequently to that, we had another big decline in bond yields. Oh, I'd like to make another point here. This red arrow, when the bull market started in stocks, bond yields started to rally. And we're going to come back to that in a minute, because this could speak to the reward to risk characteristics of bonds to stocks right now. Here we have an important reaccumulation area here. In 2011, 2012, the economy slowed down, produced a pause in the stock market after a good initial bull run. Well, look what happened. Treasury yields fell down on the 20-year to parity again with the S&P 500 yield, making the S&P 500 really a bond surrogate. So we can see here this green arrow. We already had the uptrend starting. It jumped up and out, and so it was ready to begin its new run. 2012 to 2016 glorious advance in stocks. Well, look what happened to bond yields. They started to rally. Bond yields went up really because the economy was getting strong. Economy was improving. Stocks were in demand. Money was migrating away from the bond market into the economy and into the stock market. So it produced a bear market in bonds. So we must keep that in mind. So in here, you can see again, parity where bond yields actually went below stock yields for some period of time and produced a reaccumulation, a pause. Eventually, an uptrend began, climbed up and out, backed up, and then began another really important rally in 2016, 2017, and this resulted again in another bear market for bonds. And so where are we now? We are in something that looks like another reaccumulation. We've had this big decline in bonds, so we've had a big bull run in bond prices, a drop in yields, parity at this area of about 1.87% yield in 20-year treasuries to the S&P 500. So historically, in these examples that we've just looked at, that represented a time when stocks were a good value in comparison to bonds. So the thing that we must keep in mind is that this condition could put a floor under stock prices and money could migrate back away from these very low yielding bonds and negative yielding bonds in the world back into stocks. And so this is really important because this could put a floor under the market. And notice this, stocks have rallied up and out of their reaccumulation area and are now backing up to the top of where they broke out, the top that was made back in January of 2018. So this whole area could be another reaccumulation, just like the prior ones in this accumulation area here, all produced by the same condition of parity between bond yields and stock yields. So with that in mind, let's move on and look at some examples of what's been going on with stock yields, because stocks have some characteristics that make them attractive to the bond market, and we want to keep those in mind. Okay, so here we have a very interesting ETF. This is based on the S&P 500 Dividend Aristocrats. This is NOBL as the symbol. You can trade this, own it, and you can see here that the yield on the Aristocrats is right here, 2.07. It's not significantly higher than the yield on the S&P 500, which is 1.85. But here's the thing, every stock in the Aristocrats is an S&P 500 stock that has paid and increased their dividends in each of the last 25 years. And so here's the great thing about stocks, is that stocks are can be like bonds, and that they have at this time, because they have parity, yield parity. But the thing about stocks is because they are companies that grow their earnings, they can and do grow their dividends. And so the dividend yield can go up year after year after year. And so the Aristocrats is a great example of that. You can see here that the Aristocrats have got an important reaccumulation type structure. They've rallied up, backed up. Now they've had another rally, a shallow back up here. they are in a position where, look at the relative strength. Now, it's very hard for the aristocrats to get good relative strength above the S&P 500 because they're all S&P 500 stocks. The one thing they have is they have yield, and they tend to be the top yielders in the index. And you can see here that at 2.07, the yield is quite good, but the real advantage of the aristocrats is they keep growing their yield. Year after year after year. So there are times when the aristocrats will have declining relative strength, and that simply is because the market typically is in a strong bull run, strong economic run, and growth is valued over income in those periods. But notice this, that even when the relative strength is dropping, the price of the aristocrats were going up. So they were just going up at a slightly lesser pace. So growth was preferred at those times. And then when in the periods when there's reaccumulation going on or a pause in the economy, the aristocrats will tend to get favorable treatment because they have high yield and they're growing their yield. Okay, so this is an important theme. Let's move on and look at some others. Here is the utility ETF, and here you can see that the utilities have a yield that's about 65 basis points above the yield of the S&P and above the yield of the 10-year, 20-year treasuries. Beautiful uptrend. Look, these 3 points, just trend line analysis, these 3 points produced a trend channel. Look at all the touches on the way up. Just because of the stride that was characterized here at the very beginning. Beautiful trend channel. We're up near the top of the trend channel. Remember that once we start to turn up the stock market after a period on that chart we looked at, the bond market will tend to go into, in short order, weeks to months later, will tend to go into a bear market. And for you bond traders, keep that in mind. So if we do get strengthening economy because of these low rates, it will tend to produce a stronger economy and rising interest rates in some capacity. But at this time, this isn't really our point here, is about the relationship of yield to stock yields to bond yields. You can see that we have a beautiful uptrend, dominant characteristics in the utilities on relative strength, nice uptrend in utilities. Well, this is something, again, if the economy gets strong, it probably will show the utilities having a slightly lower growth rate, and the relative strength will flatten out and potentially turn down. We are up near the top of the trend channel here, but there's really good yield here. And so 2.5% of yield that's generated year in and year out on these utilities continuously, which adds to performance. So that's really important. Okay, so let's keep going. We have more to do. I want to look here. Okay, here's the Dow utilities just so you can see them. Really the same picture. Let's look at real estate. This is the XLRE, which is a sector, real estate sector. This is a very high yielding sector because it's primarily REITs, REITs. 3.05. This yield is, let's see, it would be about 120 basis points higher than the bond market right now. And look at this beautiful uptrend near the top of the channel at this time, but it's it may produce a pause, but look at the dominant relative strength characteristics on real estate since the beginning of 2018. This has just been a great place to be, and with some kind of a pause, it's most likely going to continue to produce good characteristics because the yield's so much higher than the bond market. And so it would probably take quite a bear market in bonds to really curb the enthusiasm towards real estate. Matter of fact, I almost think of real estate as a bond surrogate, not just the REITs, but in general, in this new world order that we have where rates are so low. Okay. This is interesting. I want to talk about the healthcare sector for a bit, because even though the yield is low on this sector, 1.54 compared to the yield on the S&P 500, it's still a pretty attractive yield for the whole sector. So you could find, I'm sure, individual stocks that would be very attractive in the healthcare space that you could own with competitive yields. But notice this. There's been some talk about hedge funds moving away from technology and towards healthcare. Well, I think there's some green shoots in the healthcare sector, but I also am continuing to see good relative strength in technology. And so, especially if the market can turn up and find good support here because of this yield parity, I would think that a growing economy could be good, not only for technology, but also for healthcare. And you can see the relative strength has been declining since late 2018. And we have something akin to a reaccumulation structure that has formed for quite some time in healthcare. Well, look here, rally up to resistance, and now we have a backup. Backup is shallow. Volume is not particularly high. A lot of volume right at the lows. There's some good tails here on these weekly bars. And now with a pivot up and out, we could take a count of this whole area on healthcare, and it would be a substantial count for higher prices. So I think that if we can get relative strength to climb above its moving average here and start to show some leadership characteristics in its uptrend as it has done in the past, then I think that healthcare could be an excellent place to have a theme and also get yield and growth of yield over time. So this is, I think, a very interesting place. Okay, let's clean up my mess, move on. We have one more to do. We have just enough time to do it very quickly. And this is energy. So interestingly, I've done a point figure count. This point figure count went right to this 52.17 low, one box below the low so far. So we fulfilled this distribution count. And so this is interesting because we appear to maybe be building a cause for an important move in energy. But with that in mind, the relative strength in energy is, let me relocate things here. So here's that potential base building process. Notice this about energy, 3.55 yield. This is almost double the yield of the S&P 500 and the 20-year treasuries. And so this is an area where there's value. And so relative strength is quite low, but it's been going down for so long that with yield so high, yield bargain hunters could show up in energy in the months to come. So we're going to keep a close eye on that. You can tell I'm losing my voice. It's a good time to lose my voice because we're done. Thank you so much for being here, and we'll see you next time.